Welcome to another episode of Real Talk. We hope you're doing well and staying safe. Today's conversation is about banks, mortgages, and how the COVID-19 pandemic has and will further affect the real estate industry.
Let me introduce to you Gregory Schmidt. He's our real estate broker here in Mark International Realty. He's also an owner of mortgage brokerage and licensed in many states. Greg, please introduce yourself and tell us more about your background.
Hey guys, my name is Gregory Schmidt. Thank you very much for having me here. I think what you're doing is great, bringing as much information as you can to your community. That's really good stuff. Very important to do, right? Realtors are a part of the community, and that's important. I've been in the mortgage and real estate business since 1997. I started off as a loan officer. Back then, interest rates were 8.5%. It was a very different marketplace. You met with everybody face to face. If somebody wanted to buy a house, they had to meet with a realtor. They couldn't search online. It was a very different marketplace. I've seen all the changes. I've been here for 23 years, and I love the business. And I think there's a lot of good and concerning stuff going on out there, and we want to bring that information to everybody.
Let's dive right in. Tell me, Greg, in your words, how has the mortgage market been affected and how has it reacted to the COVID-19 crisis?
Well, as you can imagine, with so many people filing for unemployment, the lenders have had no choice but to make some changes to their guidelines. So prior to the pandemic, guidelines were loosening up a little bit. And what that means is that the banks were allowing people with lower credit scores to get mortgages, with people who, they would stretch the income requirements for people. Right. And what they did was they stopped doing that now. Now they've cut back on all those programs because they're afraid, people are unemployed and they're concerned about giving loans to people who might not have a job in a month from now. So to that extent, what happened is lenders have eliminated certain loan products. So for example, before the pandemic, if you couldn't show your income on a tax return, but you were able to do it through a bank statements, well, they don't allow that anymore. Very high balance mortgages 700,000-800,000, they have become too risky for the banks, and they've cut back on doing those kind of mortgages. Second mortgages have been affected. Some lenders won't even offer second mortgages. Chase doesn't even offer a second mortgage anymore, and Citibank does, but you have to have a lot of money in the bank with them for them to do it.
It's like $200,000. Is that the number?
It's like $200,000. You can go right to their website and see it. Also, some people before the pandemic, if they were going to buy a multifamily house, they would need the income sometimes to qualify for that mortgage. Well, since the pandemic, they have cut back on what amounts of rents they'll give you to qualify, and you have to have more money saved up after the closing to even be allowed to have those rents, because they're afraid you'll buy the property, tenants aren't going to pay because they don't have a job. They want to make sure that you have money that you can continue to pay their mortgage payment. So some of the banks, they have addressed some of these, tightening up, I would call it, their requirements. But there are also some things that they have left out. A big thing now is forbearance. A lot of people don't realize that if you're in forbearance, the current rules say you have to pay your mortgage payment for 12 months before you'll qualify. So that's kind of a big deal. And that there's also information that if you go into forbearance, they won't report that on your credit report. But that gets complicated because that doesn't apply to everybody. If Fannie Mae or Freddie Mac own your loan, and that's not every loan, you'll be okay. They won't report it. But if some other bank or servicing company owns the loan, well, they may report you in forbearance. So there has been tightening up because of the employment situation. And then there's been some sort of not updating their guidelines to address this short-term pandemic, or what we hope will be short-term.
So, Greg, speaking of forbearance, so is it something that you recommend doing, or is it something that people should completely avoid?
I believe that, each person has their own situation. I mean, we can't make a blanket statement that it's bad or good for everybody. There are ramifications to going into forbearance. So one of them I mentioned already. If you go into forbearance and the guidelines for the lenders are not updated, then you wouldn't be able to get a mortgage whether you're refinancing or purchasing for 12 consecutive payments in that forbearance. So that could be a concern if you're moving or planning to refinance or something like that. Also, once you're in forbearance, the rules haven't been clearly stated yet. Are you going to have to pay that back in a lump sum? Is it going to be made over a 12-month period? Will they extend the payments you missed to the end of the loan? There has been no clear-cut way of handling that. So somebody may have a lender that will work with them and just say, okay, pay, whatever you missed, we'll spread it over a 12 or 24-month period and you pay us back. Where another lender might say, we want it all in a lump sum. And that could cause problems because if you can't pay the lump sum payment, you start accruing late payments on your credit report, and therefore you wouldn't be able to get a mortgage for 2 years if you have paid a mortgage late. So there are ramifications. I think each person needs to evaluate where they will be at. Are they going to still have a job? If they're not going to have a job, all those factors play into whether you want to go for forbearance or not.
Absolutely. And just today, I heard the newest numbers, which jumped from 26 million to 30 million people who are currently applying for unemployment. That's a ridiculous number. So many of these people who are currently unemployed are also exercising their right for forbearance, not only with their mortgage, but also with their car payments, their credit cards, so on and so forth. Now, will all of these forbearance, unemployment, obviously these will all play a big factor and become a burden when trying to refinance or obtain a mortgage. Just make it clear to people. Is it possible to still get a mortgage today?
Well, the answer is yes, it is possible. There are mortgage closings happening every day. If you have a job and you're continuing to work, then you have no problem. They are doing verifications of employment right at the closing table to make sure that you're still going to have continued employment, but you can get a mortgage. But also I should say, if let's say you collected unemployment for a couple of months and then you're back at that same job or in the same field and you've been on that job for a month, you have a month worth of pay stubs, then you're able to apply for a mortgage, not a problem at all. The problem comes into what you had mentioned about the credit report. Some of the credit card companies, car companies are saying they won't report you late and they'll work with you on payments. What happens when that payment period is over or that forbearance period is over? What is owed and how are you going to pay it back? Because if you're going to start getting late payments 3-4 months from now, then you're still going to have the same issue that I was addressing before, that the guidelines presently, they don't address if this pandemic period, they still are generalized. If you're late on something, you have to wait a certain period of time before you're eligible for a mortgage. They don't say if you're eligible, from this period of time, we don't count it against you.
So you do believe that lenders will update their guidelines in order to lessen that burden for those that are unemployed and in forbearance?
A lot of people will remember in 2007 when the mortgage crisis happened and we fell into a recession. What happened was lenders were caught off guard. And what they did was they adjusted to that environment by just straight tightening up where no one could get a mortgage. There's a very famous story at the time, the Federal Reserve Chairman, Ben Bernanke, applied for a mortgage and was declined. This is the guy who sets the interest rates. He was declined because he could not confirm his employment would be guaranteed for the next 2 years. He was a Federal Reserve Chairman appointed by the president, could be terminated at any time. So what happened was over a 2-year period, the lenders got accustomed to the environment they were in. in the recession, people filed bankruptcy, people went into foreclosure, people had to do short sales. So it took 2 years, but after 2 years, the lenders, if you had a short sale or had a bankruptcy, immediately you were able to get a mortgage. And then as time faded away from the recession, they tightened up again. Now, if you file bankruptcy, you need 2 years. Back then, it could be 1 year. So I think that history shows lenders to want to do business and they want to address this period of time. So I do believe lenders will make adjustments. However, I do think the public can play a role by reaching out to their congressmen and congresswomen and senators to say, hey, look at this guidelines, just even about forbearance. It still says 12 months consecutive payments. Let's put in some kind of caveat where if it was during the pandemic period, it's sort of like a push, no problem, we'll still give you a mortgage. So that's something people could do. And I do think that with more noise, the lenders will update their guidelines.
That's an interesting information. Greg, I hear different things. I hear that interest rate went up. I hear interest rate went down. One of my clients that I was working with called me and he said, oh, have you heard the good news? The interest rate is 0 now. So that's a good time to buy. So I don't know. To me, of course, I mean, to me, it sounds crazy, but maybe you can, talk about, what is the interest rate right now?
Well, that's a very good question. And you're right. By the way, there is a lot of confusion in the marketplace about the rate, and I'll explain. So the interest rates are closely followed by the 10-year Treasury, and the 10-year Treasury is the lowest it's ever been. So people think, oh, well, interest rates must be lower. But there's a lot of risk out there because people are applying for this forbearance and there's no questions asked, so they don't have to make payments. The lenders have all this risk on their balance sheet of people who aren't going to make their payments. So although the treasuries are very low, lenders are slow to react to that. So if you find yourself with a good job, good credit, then today you can get an interest rate around 2.75% on a 15-year or 3.375% on a 30-year. However, if let's say you have great credit and you're looking to do a cash out refinance, well, just the other day, FHFA, which is the regulator for Fannie Mae and Freddie Mac, said that they will not purchase any cash out refinance loans that go into forbearance. And this means that lenders now are scared if they do a cash out refinance for somebody, the person after the closing may be entitled to a forbearance, no payments for who knows for how long, up to 12 months. So they're increasing the interest rate. So today, if you told me you had great credit, great job, you're working, and you wanted to get a cash out refinance, I would tell you I wouldn't be able to do it for you. It would probably be 5% with a couple of points because that's what's going on right now. So I do think that there needs to be some stabilization in the market for me to give you a better answer, but it depends on what you want to do, and it depends on how good your credit is. And of course, everybody needs to be working. You can't get a mortgage with unemployment as your income.
Greg, this info was absolutely phenomenal. I truly appreciate you coming on with us. Is there anything else you'd like to add before we?
Well, let me just say that I have been around long enough in the mortgage and real estate business to have heard the sky is falling many times. And I have myself, when interest rates were on the slide going from 8.5% when I first started lower, I kept saying, wow, they're probably going to go back up. They're probably going to go back up. Not, you never know what can happen in real estate. Our marketplace here in Staten Island is a very, very stable marketplace. It's very solid. And I believe that people should let the dust settle. Let us get back to some kind of normalcy, because right now we have this new pandemic concern. And I think once that happens, we'll have a low interest rate environment because of that 10-year Treasury being so low. And I believe that will fuel this buying of homes and getting businesses some money so they can operate and will help us, move this economy along. So I don't think people should worry. I think that people should just be informed that right now the guidelines are a little tight, but they should be loosening up hopefully once we all get back to work.
Truly invaluable information for our viewers. Thank you once again for joining us today.
My pleasure.
If you or someone you know found this information informative, please share this video. Comment below if you have any questions, or if you would like to ask any one of us a question. Greg is always on as well. He will answer any questions pertaining to mortgages or lending. If you found this video informative, please share it. Don't forget to like our page, like our videos, and hope to see you soon. Stay safe and be well.
Thank you very much for being here with us today.
My pleasure.
And for our viewers, stay safe and stay healthy.